Good morning, Jimmy.
Jeremy, how are you?
Doing great. Here we are. It's February, and if you're in the Midwest, you know that the weather's broken a little bit, and it
Yeah, the
feels
snow is pretty quickly melting away.
it feels better out there for sure. But as I often say this time of year, it's a head fake.
That's right.
So we are in for more winter, I think. But you know what? It's starting to feel like there's an end in
Yeah,
sight.
it feels nice.
It does feel good. Now, the other end in sight, and I'm not predicting this, but let's just say it, the Mag 7 is kind of gone down to the Mag 2.
Hasn't been so magnificent recently.
It has not. And so we're going to get into a couple charts here and show you all what's going on. So here are the 7. And just want to articulate this real quick. The grayish blue line in the middle, that is the S&P 500.
Right.
Traditional S&P 500. There are two stocks that are outperforming that. That's Alphabet and Nvidia over the last year plus.
Right.
So the other Magnificent Seven are all below that line.
Mm-hmm. Yeah, I mean it's again not so magnificent. One of the things that jumps out at me is looking at if you pick any of those individual company lines, you need to just look at how volatile they are individually, yet collectively as the made up of the S&P 500, much more stable, right? A much more flatter, boring looking line. It's very good returns, but much more boring. So the individual volatility is, if you've been trying to pick which of the 7 did you want to lean into, not easy. I think there's been a lot of, flows into the tech heavy Magnificent 7 ETFs, right? They've been created around them to track them because they've been so magnificent.
For sure.
So if you're trying to do that, okay. But the S&P 500 has, it's a really nice looking grayish blue line there.
It is. And, this speaks to me in terms of a lot of different things, but risk in particular.
Yeah.
And you were kind of foreshadowing it. We know that there's this thing called systematic risk and there's non-systematic risk. All right, what does that mean? Systematic risk is the market risk, right? It's the market and the economy is going to do what it's going to do.
Right.
And everybody's going to sort of float up and down with that.
Right, correct.
We all deal with that. The non-systematic risk is going to be that individual risk associated with these individual companies. What's
Right.
going on underneath the hood?
Yep.
What does their business model look like? Their
Regulatory.
Regulatory, all the things.
Yeah, right, all things.
Right? Even political things. Let's
Right.
take Tesla, for example. They've been in a political
Whirlwind, right?
for a couple of years here.
Yeah.
So you have a lot of that playing out. And sometimes it goes your way,
Yep.
and sometimes it doesn't. Alphabet's a good example of how it went to the investor's way.
Absolutely. Last year was probably one of the biggest surprises, wouldn't you say?
Absolutely. Look at it. You follow that green line right there. They are underperforming, and then all of a sudden they're outperforming everybody.
Boom.
So
Right.
They had a good story. Some of these folks did not. In particular, I'd say Microsoft's had a tough time recently.
Which is an interesting play because I think there's been so much AI craze, right? And with Microsoft's investments in OpenAI, I think a lot of people were viewing Microsoft, because OpenAI is still a privately held company, but Microsoft has a stake in OpenAI. This was sort of like a way to get an OpenAI play. So,
Yeah.
in full transparency, I'm a little surprised that Microsoft has done as poorly as it has because of the AI mania. I would have thought and expected that would be a tailwind for Microsoft, but far from it.
It's probably a buying opportunity for those who are looking for a stock that's beaten down that's probably going to be very resilient in the future.
Right, I would agree.
That said, the story here is the Magnificent Seven is really no longer so magnificent, like you were saying, and it's down to 2, and where it goes from here is anybody's guess. But the trend is that a lot of the money's coming out of these top flying stocks within the S&P 500 and
Right.
going someplace else. And the question is where?
Yeah, exactly. It's got to go somewhere, right?
So we pulled in this slide. It's the last 3 months. And one can certainly make an argument that this might be where the flows are going.
Right.
Right. So talk to me about what you're seeing here. Jimmy. There's a handful of things going on in here, but what are you seeing?
Yeah. So what we're looking at here, you see the green line at the bottom there is the S&P 500. The dark blue represents the equal weighted S&P 500. So again, big differentiation between the S&P 500 and the equal weight. The equal weight is all of the constituents of the S&P 500 are weighted equally in the index, right? Whereas the pure S&P 500 is a cap weighted index that, as the Magnificent Seven had performed so well, they started to make up a much larger portion of the S&P 500. And then on the top of both of those, we have the international, and then both the developed markets and the emerging markets. So what you're seeing, I think the domestic story here is looking at the equal weight outperforming the pure S&P 500 by such a large amount in this short period of time, just 3 months. With the equal weight up over 8 points, was 8.7%. That's an annualized almost 40% return.
It's crazy. Yeah.
So now think about that. If that's up and the S&P 500 is still up almost 2%, it's telling you that those Magnificent Seven aren't gathering as much of the flows as what they had before.
Their steam has fallen off, right?
Right.
But it does seem as though people aren't just wholesale getting out of domestic stocks, right?
Right.
They're just reallocating some of the dollars, maybe taking profit,
Sure.
right?
Right.
And reallocating it into, if you were heavy in the top 7, now you're reallocating to the other 490.
Right.
Now,
one of the things that's interesting here, I think that for the past couple of years, anytime you saw weakness in the Mag 7, it was just a buy the dip. It was like the immediate reaction, right? Buy the dip. Mag 7's down, just buy it. Not happening right now. Again, that's what you're seeing played out here in the equal weight. That money's going elsewhere. Industrials, energy, other sectors that have not done as well historically, gathering a lot more inflows. And then we have a weakening U.S. dollar trend recently, which is a very bullish tailwind for the international stocks. So you see the international, both the developed and the emerging markets, both outperforming by a good amount here. You're up over 12%, both the developed and emerging markets, and that's quite an annualized rate of return. If we're able to hold this pace for the next 9 months, that's a heck of an annual
It's
return.
ripping. I mean, let's be honest. At 12% gain over the last 3 months is amazing.
Yeah.
So, whether it sustains itself is probably unlikely. That's a very high clip. But last year, remember that it outperformed the S&P 500 as well, meaning both international markets, both international benchmarks did. So maybe in store for something like that again. It's certainly the trend is showing there's some legs there.
It certainly looks like it.
And if those things sustains through the first quarter, you usually have a pretty strong case that they will sustain through the year.
Right.
Time will tell, but it's very interesting what's going on. This is a very different marketplace than it has been for the last couple of years, I would say.
Absolutely. I mean, honestly, it feels pretty healthy to me, honestly.
It does. It feels like a reallocation that feels strong. People aren't taking their money to the sidelines.
Right.
People aren't just dumping their money into the bond market.
Right.
This seems to have breadth.
Agreed.
So there's some strength here in the markets.
I agree.
Okay, well, good. Anything else?
That's it for me.
I think that's it for me, too.
Yeah.
Well, everybody have a great day. Thanks for listening.